Hey there, future investors. Welcome to my channel, where we break down the world of finance and investing in easy-to-understand ways. If you're here today, you're probably interested in learning more about the stock market and how to get started with investing. Whether you've been thinking about it for a while or just heard about it recently, you're in the right place. Today, we're going to dive into the basics of stock market investing for beginners. By the end of this video, you'll feel more confident and motivated to start your own investing journey. So let's get started. Let's begin with the most fundamental question. What is the stock market? Simply put, the stock market is a place where people can buy and sell ownership stakes in companies. These ownership stakes are called stocks or shares. When you buy a stock, you're essentially buying a tiny part of a company, which means that as the company grows and succeeds, your investment can grow too. The stock market is often compared to a giant marketplace where buyers and sellers meet. But unlike a traditional marketplace where you might buy physical goods, in the stock market, you're buying a piece of the economic pie. The beauty of this is that stocks have the potential to generate wealth for you over time, especially when you choose the right companies to invest in. But the stock market is more than just a place to buy and sell. It's a reflection of the economy. If the economy is doing well, many companies will perform better, which in turn drives stock prices up. If things are going badly, stock prices might go down. That's why the stock market can feel unpredictable, but with patience and strategy, it's a powerful tool for building wealth. If you're wondering, why should I invest in the stock market? Let's talk about why it's such a great opportunity, especially for beginners. First of all, stock market investing has historically been one of the best ways to grow wealth over time. If you look at the performance of the stock market over the long term, it has generally trended upward. Despite the short-term ups and downs, the stock market has rewarded those who stay patient and invested for years or decades. So if you're looking to build wealth and reach financial goals like retirement or buying a home, the stock market can help you do that. Another reason to invest is to keep up with inflation. Inflation, which is the rise in prices of goods and services over time, can erode the purchasing power of your money if it's just sitting in a savings account. By investing in stocks, your money has the potential to grow faster than inflation, keeping your purchasing power strong. When you invest, you're essentially putting your money to work for you. As companies grow and prosper, so does your investment. But remember, while the stock market offers tremendous potential, it also comes with risks. It's important to understand that there will be ups and downs along the way. But with the right approach, you can manage those risks and come out on top. At a basic level, stocks represent ownership in a company. When a company sells shares of stock, it's raising money to fund its operations, growth, and development. You can think of it as being a small part owner of that company. For example, let's say you buy 100 shares of a company called XYZ Corp. If XYZ Corp does well, grows its revenue, and increases its profits, the value of your shares will likely rise. On the flip side, if the company struggles, the value of your shares may decrease. There are two main types of stock. Common stocks. This is the most popular type of stock that people invest in. When you buy common stocks, you gain voting rights in the company, though usually only a small influence, and the potential to earn dividends, payments made by the company to shareholders. Common stock is riskier, but also offers the potential for higher returns. Preferred stocks. This type of stock doesn't give you voting rights, but it offers a higher priority when it comes to receiving dividends. Preferred stockholders are paid before common stockholders, and the dividends are usually more stable. Most beginners start with common stocks, as they're more widely available and offer a chance for higher growth, but it's always important to understand the risks involved. Now let's talk about how you can actually get started in the stock market. I know the idea of investing can seem intimidating at first, but trust me, once you break it down, it's much more manageable than it seems. Step 1. Open a brokerage account. In order to buy stocks, you need to open a brokerage account. This is like a digital wallet where you store your money and make your investments. There are a lot of online brokerage platforms to choose from, such as Robinhood, Charles Schwab, Fidelity, Many of these platforms allow you to start with little to no money and offer easy-to-use apps that make investing accessible to beginners. The best part? Some brokers offer zero-commission trades, meaning you don't have to pay fees every time you buy or sell stocks. Step 2. Start with what you can afford. If you're nervous about losing money, don't worry. You don't need to invest a lot to get started. In fact, it's better to start small and learn as you go. Many beginners start by investing as little as $50 or $100. When I first started investing, I wasn't comfortable putting large sums of money into the market, so I began with just $100. I invested in a diversified mix of low-cost index funds, which we'll talk about soon, and individual stocks. Over time, I learned a lot, and that small investment grew. It wasn't an overnight success, but it gave me the confidence to continue investing. Step 3. Focus on index funds or ETFs. For beginners, one of the smartest things you can do is invest in index funds or ETFs, exchange-traded funds. These are baskets of stocks that represent a broad section of the market. For example, an S&P 500 index fund includes shares from the 500 largest U.S. companies. Why is this a good strategy for beginners? Diversification. By investing in an index fund or ETF, you're spreading your risk across many different companies, rather than putting all your money into just one stock. Lower risk. Since index funds track the performance of a whole market segment or index, they tend to be less volatile than individual stocks. Lower fees. Index funds and ETFs usually have low management fees, which means more of your money is working for you. This strategy allows you to invest in the market as a whole, rather than trying to pick individual stocks, which can be harder and riskier for beginners. One of the most important things to remember when you start investing is to have a long-term mindset. The stock market goes through cycles of ups and downs, and it can be easy to get discouraged if you're not seeing immediate results. But investing is about patience. If you can hold on to your investments through the ups and downs, you'll likely see your wealth grow over time. Here are a few tips for building a strong foundation. Dollar cost averaging. This means investing a fixed amount of money regularly, no matter what the market is doing. By doing this, you'll buy more shares when prices are low and fewer shares when prices are high. Over time, this strategy helps lower the average cost of your investments. Reinvest dividends. Some stocks pay dividends, which are a portion of the company's profits distributed to shareholders. Rather than cashing out these dividends, consider reinvesting them to buy more shares. This can accelerate your portfolio's growth over time. Diversify your portfolio. Don't put all your money into one stock or sector. Diversifying your investments helps protect you from the risk of any single company or industry struggling. Investing can feel slow at times, but trust me, every dollar you invest today is working for your future. One thing that helped me stay motivated was to set clear financial goals, like saving for a down payment on a house or contributing to my retirement fund. When you have specific goals in mind, it makes the process more rewarding. Remember, the best time to start investing was yesterday, but the second best time is today. So take that first step no matter how small. Start with just $50 or $100, and as you learn more, increase your investment over time. Congratulations! You've just learned the basics of stock market investing for beginners. It might feel overwhelming at first, but the key is to start small, stay consistent, and keep learning. Investing is a journey, not a sprint, and by taking the time to understand the basics, you're setting yourself up for long-term success. So go ahead, open that brokerage account, start with a small amount, and begin your investing journey today. You've got this, and your future self will thank you for it. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and share it with someone who might need a little nudge to get started. See you in the next video. Happy investing!